All right, so let's do PPI just real quick. Key things that you want to be looking for, and a couple of things. Good morning. Good morning. Good morning. Hi, everybody. Sorry, I'm operating on 3 cups of coffee and about 2.5 hours of sleep. This happens from time to time because I get into something and I can't let it go, and that's kind of where we are right now. All right, PPI final demand increased 1.4% for April, and everybody is very excited. Obviously, you join me because that's what's just so critical. Okay, this is a hot report off the bat. First thing, the good. We start with the good. Let's start with the good. Let's start with chicken, right? Eggs are down 49%. Remember, that's going to be the talking point. Hey, remember when eggs were very expensive under Sleepy Joe? Eh, we fixed that. That's just kind of how political talking points operate. After the bird flu spike, eggs have finally cratered. That final demand is fine. Portfolio management prices, asset manager clients, bad for Wall Street, down 2.4%. Final demand services, less trade only, rose 0.1%. That's stickier services. That was the calmest part of this report, which that's on the final demand page on two. Where are we? Where are we? And I just saw it. My eyes just, again, very, very, very tired. Zero point 0.1. Hey. All right. Transportation, 0.1. All right. Let's look at the bad stuff. Natural gas to electricity utilities up minus 3.5%, plus declines in beef and veal. That's exciting. All right. Here's the bad stuff. Headline 1.4% month over month. So there's your problem. And this is where, once again, I want to point something out. You're going to hear CNBC today say that whole prices were up 1.4% month over month. PPI is not wholesale. It has not been wholesale since 1978. They just keep using that term. I don't know why. It's as though they're trying to make me angry because this is the front end of the curve. That doesn't impact wholesale. It's not 100% wholesale here in the United States. PPI, a lot of stuff ends up abroad. Anyway, this is the largest single month jump since March 2022. And if you remember March 2022, well, that was where we got into the inflation is transitory conversations. And this is also where we got into the conversations about whether or not interest rates needed to rise more in order to address the inflation threat. At the time, the market melted up in March 2022 from the Fed meeting because people thought, oh, interest rates only needed to go up 25 basis points from zero in order for us to contain inflation. And boy, were they wrong about that. 12-month PPI is up 6%, which is mind-boggling. That is the biggest 12-month increase since December 2022, which is, again, a year after the tightening cycle had really begun. That's the very first paragraph here. Core PPI up 0.6% on the month, 4.4% over a year. That's the largest increase since 2023. Final demand up 1.2%. Trade service margins up 2.7%. Final demand goods, good grief, up 2%. Monster back-to-back prints because we were up 1.9% in March. Here's the stuff that actually is the problem. First off, paragraph 1, page 2. Here we go. I don't like this one bit. This is a bad one. Final energy demand up 7.8% in the month. 7.8. So why is that significant? Well, again, that alone explains more than probably 3/4 of the goods increase. Gasoline's up 16%, 15.6%. That's over 40% of entire goods advancement. Transportation and warehousing up 5% for a single month. Truck transportation and freight is up, and it is 1/5 of the services for intermediate demand rising. The pipeline is burning. Unprocessed goods for intermediate demand up 4.1%, 21% year over year. Crude up 11% on the month. Diesel up 12.6. Okay, you get the point. Everything is moving higher, and every single stage has just printed multi-year highs. Stage 1, 2.1%, 8.9% year over year. And the key thing here, the bottom line, and this is the worst PPI report in 4 years. So headline 1.4%. And just another reminder of how these markets actually work, how they actually operate. Well, let's actually dig into what actually matters in this market. So I'm going to pluck this down real quick. This is just kind of screwy the way that this actually operates. And I'm going to talk to you about what we saw yesterday and what has kept me up for the last 26 hours. We'll go from there. All right, let's dig into it. And we're going to do our morning stuff as well. And I really want you to pay attention to this because this is uh, Andrew Bird, my finest work type of analysis here, and you're only going to get it here out of one bloodshot eye at 8:38 in the morning. All right, so key thing here. Let's just talk about this element of how the piping works. Okay, so as I said, how do we get from how do we get to all time highs when the average stock is doing nothing? When the equal weight stocks have been doing absolutely nothing? Um, and when CPI goes up the way it does. Now, if this is a breaking point, and we're going to let this simmer a little bit, we're not going to dive in right away to what the reaction is because sometimes markets will take their sweet time, but we are at divergence on the S&P 500 and Nasdaq. We saw the Russell move into negative territory on equal weight yesterday and bounce right back, and that all goes back to this thesis, this conversation that we're going to have over the next 10 minutes before we get into the last 10 minutes, which will just be basic plumbing for today's environment. Obviously, Trump's going to China. Hey, that's a great big story, but this is not what we're focusing on right now. Instead, what we're focusing on is the fact that we have these prints, this PPI number, and for some reason, we continue to move to these levels. All right. So CPI comes in at 3.8 yesterday. All right. This is some people are actually projecting that inflation is going to hit 5% this year. And the S&P 500 sits near these all-time highs and the markets are completely concentrated into 7 stocks. Why? Okay? I really want to slow this down. For the last couple of weeks, we talked about the Treasury. We've talked about the Fed continuing to support markets through its reserve asset management. We had changes in regulations that kind of allowed the Treasury to get away with some things that happened in April. And we had heavy cap weighted momentum that has taken the S&P 500 to these highs. Okay. We've also had extremely weak breadth. So it's just a small number of stocks. And what we never really did was look at a couple of the key elements that have happened since 2008. So this is why I've been up all night. And this is why we wrote what we wrote. Today, we have to explore the moving parts to show why this market has occasionally bended but will not break. And there are 2 research papers, which I noted, that have lived rent free in my head for 13 years. And it finally all kind of came together. So the first is AEI's John Makin, and he wrote this back in 2013, and it was called Currency Wars and the Paradox of Global Thrift. I read this paper in graduate school, and I remember thinking to myself that the monetary system was completely and totally absurd and completely and totally paradoxical. And I thought, there's no way I'm going to spend the rest of my life focusing on how any of this works. And here we are, still trying to make sense of it every single day. So when he ran this piece, every single economy, major economy, was doing the exact same thing at the same time. They were printing money, they were slashing their spending, they were hoping that a weak currency would allow them to export out of trouble, right? Weak currency, more exports, right? Making yourself more competitive on the global markets. Problem was everybody did it at the same time, which is basically like everybody's got a 2 and a 5 and they're playing poker and they're trying to lose. And then they turn their cards over and everybody at the table also has a 2 and a 5. So this zero sum game basically ended up with everybody doing the same thing. And that created a problem. And the problem was something that really I never was able to shake. He warned that easy money does nothing to boost aggregate supply in an economy. And what that means is once you reach full employment, it just creates more demand for a given quantity of goods. It is a classic recipe for inflation. And he wrote that 13 years ago. And the CPI just prints 3.8% and PPI just rolls in at 6%. So this man was writing the diagnosis before the patient was ever even born. So here's the part that nobody followed far enough. The easy money was supposed to stimulate domestic lending in these other nations. And what actually happened was developed market borrowers would not borrow. Their balance sheets were wrecked from 2008, and they were still basically trying to find a way to look for ways to actually lead to a better economy, and they weren't getting it. And their money, instead of staying domestic and actually stimulating that economy, it actually went somewhere else where it could be absorbed. And Reuben Calderon and Fidelity documented where it went. The BIS data had shown that effectively emerging market lending increased for 10 consecutive quarters while other economies lending, advanced economies, flatlined. And what had happened was money just sloshed into all of these places over time. And Brazil's president complained that ultimately this was just a massive tsunami of money. Now, I'm going to get to the point on this in a moment, okay? She wasn't wrong. QE did not push dollars out. It simultaneously pulled foreign capital in. It inflated US assets. It made the S&P 500 the deepest and the most liquid market in the planet. The Federal Reserve created gravity that sucked in every pension fund, every sovereign wealth manager, every insurance company in the world that needed a return. They turned to US equity markets. So money flowed out through the credit channel and back in through the equity channel. And the drain and the fountain were the exact same pipe. Then Helene Ray writes this other piece, Jackson Hole 2013. We talked about the trilemma story from Capital Flows yesterday, and I was going, why do I know this so well? Well, it was because of this report. And this was presented in Jackson Hole in 2013. And if Macon showed us that the plumbing was absurd, Ray showed us why the plumbing could never be fixed. This is how the system works after '08. The old textbook version of international finance was this trilemma. Every country gets to pick two or three things: free capital movement, a fixed exchange rate, or independent monetary policy. You pick two, you lose one, and you go home. The whole framework assumed that if you floated your currency, you got monetary independence back. You can run your own policy without worrying about what the Fed is doing. But Ray looked at the data and said that the trilemma concept itself was wrong, and said in a world dominated by cross-border balance sheets and dollar-denominated capital markets, even floating exchange rates don't restore monetary independence. Now, what does that mean? Ray was effectively arguing that the trilemma was actually a dilemma. Either you manage your capital account or you submit to the global financial cycle, meaning the Federal Reserve, and there isn't a third option. And why does this matter? It matters because her mechanism was very simple. When the Fed eased, it suppressed the VIX. Low VIX meant low measured risk. Low measured risk meant banks levered up. Levered banks extend more credit. More credit means more capital flows. More capital flows inflate asset prices globally. Everything moved together and co-moving with the VIX like a school of fish responding to the same current. And the current started with the Federal Reserve. But the issue now, and this is where Howe is talked about, and this is where we're seeing this more, the Treasury Department is even more involved now in terms of ensuring that there is stability in the bond markets. So instead of money printing causing capital flight, which is what every single textbook has predicted through time, we ended up with a paradox. And that paradox was money printing strengthening the gravitational pull of the dollar system itself. QE suppressed volatility, which compressed safe yields, which stabilized dollar funding, which pushed every investor on earth outward on the risk curve toward U.S. financial assets. And the Fed doesn't weaken its own gravitational field by printing, it actually intensifies it. This is the intellectual bridge that explains that Macon paradox. QE was supposed to stimulate domestic lending. It didn't do that. It succeeded spectacularly at doing something completely different than nobody was targeting. So it was turning the U.S. equity market into basically a black hole for global savings. And the drain and the fountain were the same pipe because the global financial cycle made them the same pipe. That dynamic never went away. It just ultimately put it all in a new outfit. And we saw this movie play out already. This is why it all feels so familiar. You don't need to go back to 2012, 2013. We saw it happen in COVID. In March 2020, the government opened every pipe at once. There was trillions of dollars that entered the system, and for about a year, the money went everywhere. It went into SPACs, it went into meme stocks, Peloton, ARK, crypto, NFTs with apes. All the people were buying gloves, rubber gloves, and storing them in units, saying that they were going to double their money if they could own all of the healthcare and medical supplies. It was an insane time. And in 2021, something significant happened. ARK peaked, Peloton peaked, all those meme names rolled over and they went home. But the S&P 500 kept going, and it rallied from roughly 3,900 in February in 2021 to 4,800 by late December. It was another 10 months of gains because the mega cap stocks were the things that absorbed every dollar that was leaving the speculative trade. The Russell went sideways. The average stock didn't participate. The index was being dragged to new highs by shrinking group of stocks, while the rest of the market sat and on the bench doing nothing. That is not a historical, curiosity. What it really is the template for now. The S&P 500 is above 74. It was above 7,400. Equal weight was up 15 points. The cap weight that we have was 114. The mega caps are absorbing everything, and the Russell is not doing ton. And CNBC is celebrating the new highs like somebody's throwing a birthday party at a house where 3 rooms are on fire. The reality is the plumbing changed. The pipe changed. The plumbing didn't. And this is where we are right now. In 2012, the excess liquidity flowed through credit. In 2021, it flowed through fiscal stimulus. And right now, it's flowing through AI capital expenditures. So the 4 largest hyperscalers have combined capex budgets of roughly $700 to $800 billion. And the money funding, that spending does not all originate in the United States. It's coming from Japanese pension funds that can't find yield domestically because they've been sitting on rates for decades. It comes from European insurers that are chasing returns in dollar-denominated assets. It's coming from Gulf sovereign funds that are recycling oil revenue dollars into U.S. equities. It's coming from Korean institutions that are shipping savings abroad because they don't have a domestic AI equity deep enough to absorb all of it. And Ray's global financial cycle explains why all that capital ends up in the same place. The VIX is low, and this capital flows talked about this. The measured risk is low, leverage is expanding. The cycle is pulling every dollar, every yen, every euro, every real toward the deepest liquid assets on the planet. And what happens is it ends up being 7 stocks. So Capital Flows Research published that framework, talked about it yesterday, I believe, the mechanical structure underneath all of it. They mapped out that every economy onto that trinity. The countries with open capital and cap rates like Japan become net exports of AI capital. Countries with open capital and a floating currency like the US become the kitchen sink. And the countries that wall themselves off, like China, route the money internally through SMIC and some of the other AI names. That's the mechanical explanation. The core line, and it's a good one, AI CapEx is not the sector, it's the cross-border capital flow. And where money lands is decided by Trinity geometry, not innovation. That's the explanation for why we're at an all-time high, but the average stock is not doing anything. That's the key story here. So the questions become, right? Money has nowhere to go. NVIDIA is not just a stock at this point. It ends up being where world excess capital ends up while every other pipe in the system is clogged. Calderon cataloged 4 consequences for the 2012 flow. It was inflation, currency distortion, commodity financialization, and threats of retaliation. And all 4 are showing up right now. Inflation is up, driven by energy costs, and that's bleeding into everything. George Savarellos at Deutsche Bank documented that 80% of recent foreign inflows into U.S. stocks are hedged, with foreigners sitting on $26 trillion in U.S. assets and cutting dollar exposure at an unprecedented pace. Crude above $100 financializing downstream into a conversion layer we wrote about last week, and Korea floating the idea of taxing AI profits now and redistributing the revenue as citizen dividends, while Rusev's 2012 complaint is wearing a different hat. The benefits to your to capital flows are accruing to just basically a handful of companies, while the costs are being distributed to all citizens, and we're going to have to do something about that. So, what actually breaks all this at the end? Well, I'm going through everybody's stuff right now, and House talked about this being the top of a 65-month liquidity cycle. Capital flows is effectively saying that AI and capex can't be captured by some of these liquidity cycles. So there's the difference between these two voices on liquidity in the global system. His biggest concern is the debt maturity wall later this year. He's talked about that extensively. And every time that interest rates rise, and we pay very close attention to the commercial real estate market, we know that there still is something there. There's something brewing here, and the US government has to refinance trillions and trillions of dollars of short term debt. Saravelos found that 1% increasing in foreign hedging ratios triggers about $260 billion in dollar selling. So the dollar is mechanically linked to equity multiples through foreign positioning. This means that when local currency returns for foreign investors shrink, they sell U.S. equities to repatriate. FX would move first and equities would follow. And it goes back to our 2026 outlook that the biggest risk remains foreign money goes home. The BIS also reporting Bulletin 120, how hyperscalers have outgrown their cash flows and are shifting to debt financing. That is building off balance sheet structures that mask leverage through private credit and special purpose vehicles. So private credit funds originated over $40 billion in AI related loans in 2025, up from $3 billion in 2010. And the BIS noted that the structures mask leverage by moving it off balance sheet, yet leverage doesn't disappear by being out of sight. That last sentence is the kind of thing that regulators write when they are describing things that explode. So let's just connect everything, right? Global liquidity is rolling over. Foreign investors are hedging aggressively against the dollar. AI capex financed with hidden leverage. The debt maturity wall forces refinancing. Ray's framework tells you what happens next. If the VIX rises, the mechanism reverses, leverage contracts, credit dries up, capital repatriates. The financial cycle doesn't gently decelerate. It shifts into reverse. And the same synchronization that pulled everything up can and will pull things down. And it's just a reminder that the plumbing that flooded emerging markets with excess capital in 2012 is the same plumbing that is leading this money back, that is chasing alpha in the US. So that's the bigger question, right? The big story right now remains the same. We have to take a step back and recognize that no, this is not in any capacity a rational market in terms of what we were educated on in terms of understanding earnings. They don't talk about this stuff in CFA courses. We don't dig into this in MBA classes. This is stuff that is on the extreme of people who are insane, who are actually doing this with their time like I am, because we're trying to really truly understand how and what is happening, because people know something is off or something is different and they can't really figure out how. So that's really why I wanted to take the time this morning, a little longer than I usually do, to walk you through kind of the academic approaches here and what a lot of these people are saying, because once again, this is going to, in the event that we see the unwinding of currency and abroad, we see money flow back to China, or forgive me, to Japan or to Europe. It's going to be quick. It's going to be very, very violent, and we just have to be prepared for it. And we have to ride momentum according to the way these cycles work. You can see it in the numbers this morning, right? Plus 21, plus 10, but you have a cap number that is extraordinary comparatively. This is significant. 6-1 on that ratio, 3-1 on the NASDAQ, 4-5-1 on the Russell. It's saying that money is crowding into very specific places, all while consumer cyclical stocks are getting beaten up. And this is a canary in the coal mine for momentum, because momentum is really truly driven by three sectors: communication services, cyclicals, but technology being the number one. And if technology really starts to roll over, and I'm not talking about the stocks that are at the top. You're seeing it already in the ecosystem of technology. You have a ton of stocks in tech that are down, and all you have to do just to pay attention to this is look at what is going on the Russell. Go to the sector, go to tech, look at the number of stocks that are up 5% on the week versus down on the month, right? So we're going to start with up on the month and up on the week, and this is the whole tech sector of the Russell. You're going to start to see that there is pronounced weakness that has formed here. 29 stocks, 29 stock, forgive me, month down, forgive me. 36 stocks, 36 equities in the tech sector in the Russell 2000, down 5% on the week, down on the month. Turn it around and look at how this actually works and look at the breadth. 36 against 50. This was basically just a couple of weeks ago. There was nothing on the downside. There was like two stocks. This is how quickly this is starting to turn around. If you raise the beta above 1, you're at 23. And if you drop the beta and then you go to -5, 23 on 15. So it's narrowing. Pay very close attention to this. Pay very close. And you're seeing where the weakness is. It's software application stuff all over again, software infrastructure. It's a lot of the story about AI that we've already been talking about. So that's going to be where you're keeping your eye and your focus if technology starts to roll over. And then we have to do the rest of our conversation as always. Sorry, Whispering Candle. I hope that I didn't bore you to death. If I did, that's okay. All right. Before we got to the market this morning, this was kind of where we were, right? 3.8% on that number, 30% odds of a rate hike in December. NASDAQ futures were up before this report. But again, 2021 all over again. CPI numbers, market sold off, it clawed back. And it's another reminder, if you're a trader or whatever you're doing, you have to pay attention to volume weighted average price. I can't stress this enough, because yesterday what happens is you've got this very ugly, gnarly sell-off that is transpiring, and you start to pay attention to VWAP and what is happening during the day. The market sells off. This is Monday, right? We go into Tuesday, we sell off, and then we just burn above VWAP at 280, and by the end of the day, we're at 282. We tapped out here at 1123. The one thing that I remind you is that if people are trying to short, what ends up happening? People are trying to short at 278. We're already down 2% on the day. And the market turns right back around. And if you watch the SPY, you saw yesterday a move into the third deviation line. The second we got above VWAP on a low volume day, this is a reminder, you buy into the at the money call for the day expiration, low volume. We just burned higher all day. You buy that for 734. It's probably about $1.50 at that time. And then you finish the day at $4. So VWAP, you buy at the line, you set a stop, and you just look for a continuation of a burn higher, as, of course, broker dealers and money managers have to hedge their positions as we start to see that little bit of an incremental run higher. Pretty good trade, pretty clean way to trade. And once again, it's a reminder, markets just don't go down. They chop, they oscillate. What we start to look for in the event that we do go the wrong way is lower highs and lower lows. So real quick thing, right? Everybody's talking about interest rates. Really, at the end of the day, it's about the treasury. It's about that foreign capital flow. And if money goes home, and we're going to continue to watch that, obviously, we're going to pay very close attention to what's going on in England. Interest rates rising, and yet the markets have remained resilient. Trump arrives in Beijing today. We've got a big conversation going on right now. The summit will run through Thursday. Nonstop wall-to-wall coverage. Biggest story in the world and biases to the upside, but let it develop before trading it. Warsh will get his chair vote today. Powell's term expires Friday, and we did the PPI numbers this morning. The VIX is falling back into that descending trend after popping above the channel yesterday. The FNGD is still melting. Fuel to go higher, but is getting stretched. And remember the two markets. INTC is now up at 100% in a month. AMD not far behind. It's all tech. It's all flowing in. It's all chasing the same returns. Cyclicals are under pressure, which is why you got to know what you own when you own it. If you don't have a good answer, let it go. And healthcare's cheap. DVA's looking strong. ELV's worth watching. And the launch pad, the only name that we really see with potential is Alcoa, which is AA at the moment. Alcoa Corporation kind of trying to wake back up. Stock's been actually pretty interesting from a volume weighted average price perspective. And I remind you that if you're trading VWAP as we move through the week, all of those names, a name like that has a lot of volume to it. So what are you doing? You're doing the same thing. You go to over that screener, you pluck those stocks, you throw it into the volume weighted average price. You trade it the same way, particularly as we're moving toward the end of the week. You're buying right above the VWAP line and you're looking for a burn higher, or you're looking for a reversion. And these stocks are higher quality. They're right around that 28-day moving average. You want to know when you're entering them. You want to be paying attention during the day to where you might be opening a position. If you're up here in the stretch territory, that's the wrong place. You want to be taking that list and looking for reversals and potential moves to the upside down here in the bottom bands in that 97th to 98th percentile of expected moves. Wow. I am all right. Headlines to move the tape. Treasury yields again moving lower despite that stickier CPI. We'll pay attention to what's happening next. Oil prices, CPI. The Senate will confirm Warsh. Venture Global had a Q1 beat. Revenue at 4.6 over 4.1 estimations, raising its EBITDA outlook. Fervo IPO at $27, raising $1.8 billion, and AI-driven power demand. This is going to be a VWAP name as well. FRVO. I don't know if this is the right price for this stock. I just don't know. But as you know, I really like the story. I like the geothermal story. It's been a great year for names like Ormat. It's been great for GE, for Nova. It's been great for all the companies that are involved. This seems to be where, a lot of the attention continues to flow. There is a great stack here for AI data centers, power production, and everything that comes with it out in Utah and Nevada. Just watch this name. I might just buy some shares and throw it into a very long-term fund and never look at it again. AEP is looking for a $2.6 billion offering, and power prices were up pretty big. Stress testing, again, the breath is getting louder. Everything is concentrated in one equity system. This could go on a lot longer than people think. Qualcomm had a horrible day yesterday after a 53% month falling 11%. A reminder that after these types of moves, that when stocks start to show some cracks, the selling can move very quickly. So the biggest names are holding the index up while the rest is drifting lower, and the S&P is where the gap is the widest. Insider buying is kind of meh. Dimension Capital. We've seen a lot of cluster purchases in recent days, but nothing that really is exciting. Core CPI, again, at 2.8, services at 3.3. The PPI number is brutal. Goolsby saying that we're going the wrong way into categories that have nothing to do with oil and tariffs. We just saw that this morning. The system is still choosing loose over inflation. And if you saw what we had here this morning, Whispering Candle has talked about this. It's really the National Economic Conditions Index, which has continued to expand. So we know what to do here. Stay with what's working. Let China develop. This can go on a lot longer than people realize, and Mr. Burry may realize that soon too. Remember, he bet against housing years in advance and nearly blew up. Ultimately, he was right, but it is a long, painful process for this market to correct accordingly. All right, so couple of things. Go through this real quick. We're going to wrap it up in about 8 minutes, just so I can get everything out. You'd sleep better if your Orioles could beat the. We can't beat anybody. This is a terrible baseball team. I've given up. I've watched 2 games this year. I can't do it. It's awful. I've been watching the Cubs. That's just as painful. So I might just mail it in and pick a new sport. What can we watch? Women's lacrosse. We'll do that. Lake Show. Pay attention to the Lake Show. All right. Why are the slides with the black background zoomed in and Garrett's picture is gone? I have no idea. Who knows? Could be anything. How come Ken Ragoff still mentions the trilemma in his book, Our Dollar, Your Dollar? So, again, I think what you would argue here, Shale, is the idea here is that a lot of people still go with the trilemma, which I'm not saying I don't know who's right and who's wrong. All I was really doing is citing the work of Ray going back to that 2013 argument. And I think that Capital Flows really did a good job, laying out every single country and how it is how accordingly they're being impacted. So I'm not saying that it's wrong. I just looked at it through the lens of what Ray had written about. And I think combining Ray with some of the other content that we talked about this morning with Macon and the AEI report. It just I'm not I don't I'm not going to say who's right or who's wrong. I will say though that it is still very very blatantly clear that in the international system, the Federal Reserve, or at least monetary and fiscal policy here in the United States, still is driving the bus. And you can either be a part of it or uh, you can move on. Do you recommend only buying at VWAP if the 3 minute shows eight? Matt, that's a good question. I think I don't necessarily just say, hey, do that, because again, you could pull the Bollinger Bands out as well and use the bottom of the range on Bollinger Bands. It's a different setup, but obviously we have it on that screen. You can see the way that this is set up between VWAP and then that tight barrier that you have here. Those are your Bollinger Bands. You're looking for things to narrow and then start to expand. Um, that's one way, but I mean the 3 minute chart combined with VWAP, why is that relevant? Well, it just gives you more conviction. That's really the key thing. With the infusion of billions of dollars every month into the repo system, what is the effect of the various types of bonds and durations held in ETFs and their returns? Mike, the key thing here is that capital that's flowing in is designed to do one thing, and that's to provide stability and reduce. How will argue the move index? I mean, you can talk just about volatility itself. It's really just about ensuring that we remove the marginal sellers on the end and the forced selling in U.S. debt. And this goes back to a statement that I wrote like 6 months ago, and I can't really remember exactly how I articulated it, but it's just a reminder that it's not a free market system. It's this continuous, centrally planned mechanism that is the underlying base of the global financial system, where the United States is trying to ensure stability in its borrowing patterns. It's doing what is ever necessary to stabilize and create that to stabilize the system itself and not blow out yields and be in a situation where we're paying 6, 7, 8, 9% on the 10-year bond, because that would just be catastrophic. So if they're doing that, if they're manipulating, or whatever term you want to utilize, if their focus is on monetary or financial stability, which it's very clear that's the case, because the Fed's mandate is what? Inflation and jobs. Well, they sure to shit have ignored that for 20 years, going back 30 years if you want, right? The entire process of quantitative monetary inflation targeting, which started in the 90s. They didn't even tell anybody they were doing it for 15, 20 years. So if they're not doing what is necessary to address inflation, which would be what? Raising interest rates, using the one blunt instrument they have. If they did that, right? Well, what would happen? Well, all those short-term bills that we are using right now would spike and our short duration yield would increase. Now, it would be very painful for a short period of time, and we probably would pay a ton. It would probably lead to a very sharp recession if we raised interest rates to 6, 7%. But we never did it. And we should have done it in 2020, 2022. We should have done it. And we didn't. We didn't do it. And we didn't do it largely, I think, for political reasons. So, once again, here we are kicking the can down the road. The can is now right in front of us again. And instead of doing what the Fed would need to do, which is a Volcker type thing, Volcker had a completely different balance sheet, a completely different debt structure at the time. They can't do it. So what are they aiming to do? Stabilize the system. They're clearly not worried about the job market, considering that only like 60% of able-bodied workers are doing anything, right? So it's just a massive system of transfer payments. The reality is that they're boxed in, and we're in this situation now where things feel extraordinarily weird and people are looking for explanations, and this is the one that I got. So, over time, the commitment and the focus on trying to stabilize, moving things more to the front end of the curve, trying to lower your yield, your borrowing costs over time. They can try to cap things. That's not working. We've seen historically where you try to set interest rates, that leads to inflation. That happened post World War II. These things are just continuing to manifest, and it's going to be just more of the same, right? Cool. We got 209 people. That's exciting. Thank you. Thanks for joining us. All right. Maybe you could do one of the posts on the. It's. I would just go read Capital. Go read Capital Flows. They are on it. Right. They do a show every day too. I think they do like an hour. So I think it's at like 11:30. So go watch that. You don't need me to. I don't. I'm too tired. I don't want to. I don't want to do this no more. TXO looked good in the insider buying. Yes, it did have an insider buy. Any opinion about Apple will drive up continued short term. Again, with Apple and these other names, it's really about the fact that they're part of this Mag 7. And, you know, yeah, Apple hasn't necessarily had this massive commitment as much as some of the other companies have from an outspoken perspective on what their AI would look like and their CapEx and everything else. But the reality is they're appointing a new CEO who is a products person who is going to lead this company through this next phase. And that next phase is very clearly going to probably be aligned with AI hardware. So keep that in mind. It's a very quiet and subtle nod to the AI movement. As far as I don't dig into into Apple's balance sheet, on any capacity. But the reality is, you could see like the stock is up 20% since the bottom, right? This is how the markets are working. It's the same thing over and over again. Short term, everybody freaks out. Then they print money like they did in Japan, and we went from 257 up to 285. Why? Because Apple is one of those stocks that is heavily borrowed on margin. It's heavily leveraged. It's part of the Mag 7. It's got massive passive flows. This is one of those stocks that, again, if you just own Apple, you can just sit on the fact that every 2 weeks, people put money into their retirement accounts, comes out of their paycheck, it goes into the SPY, it goes into the tech sector, and Apple is a beneficiary because Apple is in more than 1,500, 1,600 ETFs. So what is it telling you over the long term? Hey, it's going to go up. But if there's these liquidity problems in the short term, it's going to go down. And until we see a radical shift in the perspective of how capital is flowing in and out of the system, then obviously it's going to be more of the same. That's it. Okay. Greenspan messed everything up. I don't think that that's an unfair criticism, but again, I would if you want to really think about this, and I'll do 5 more minutes on this because it's one of those things where I think when you really assess and try to understand how we got where we got, right? You can go back to 1971, come off the gold standard, and yes, that's where these cycles really kick in. We've shown that Ansley Wealth chart that follows the cross border capital cycles of wealth. That's in the wave speech, which is I got to do another video of this, but this goes back to the liquidity side of it, which was there, right? So this is cross-border capital's liquidity index, and you could see the rise in the fall. And this all comes post Nixon shock, right? And this goes up to 2024. And this is an Australian group, Ainsley Wealth, that had put this together. So that's obviously a very critical moment. The Federal Reserve really, 1913, that's important. 1945 is extremely important. 1929 is extremely important. But I'm going to go with 1993 because 1993 is where we get 6 things. The first is the start of passive investment flows. The second is, and I think I have this. I should have listed this somewhere. There it is. Yeah, good. So 1993, we got Jackson Hole, the inflation targeting. That kind of kicks in through the decade, but it really kind of kicks around those years. And that's where they say, hey, we're going to aim for 2% inflation. And the monetary academics who had never worked there before, right? They bring in the Janet Yellens as advisors. They push for inflation targeting to support the labor market. And monetary policy for the next 20 years, they don't tell anybody that they're targeting 2%. Slips out in a speech by Bernanke, 2010, 2012, one of those 2 years. I'm too tired. But the reality is that in that environment, that's where the real tinkering starts. They did not run a 0% target. They ran a 2% target, and that compounds, right? Just do 2%. If you're aiming for 2% inflation over 35 years, I mean, what's that do to the currency itself? Then you had the fiscal elements, the Clinton tax cap. This goes back to the rule that every time the people say, "Hey, we have a policy to make things more fair," usually they screw that up. And 1993 is a perfect example of this. They tried to cap executive pay in the 1990s so that at that point, if it was over $1 million, companies could not write off executive compensation on their taxes over $1 million. So companies changed their payment structures and they started paying everybody in stock and options right as the inflation targeting started. And the 30 to 1 that had transpired right between the CEO and the average worker in terms of pay displacement went from 30 to 1 to 420 in like 5 years, in like 3 years. Took no time. Supply is Executive Order 866. These people hated, the guy who was I've already forgotten his name, who was the vice president of, under Bush 1. I'm blanking on his name. That's how unbelievably tired I am. He spelled potato wrong, that guy. You know who it is. Can you put that chart back up, please? The Ainsley one, this one? That one? Okay. So, I forget his name. That's Quayle, thank you. Oh, man. What an unforgettable person. Um, so Quayle wanted to do this supply side work, basically like opening up the US economy to doing whatever, almost like privately managed in some capacity. And the Democrats didn't like that. So they then they created these rules that basically said that if you were going to do anything that was economically significant of like $100 million, that it had to go through this like central bureaucracy for a rubber stamp. And who they put in charge of it? Al Gore. And Al Gore has the say over whether or not you can build a mine or build a big factory. Well, you know where he sat environmentally. So this becomes this situation where they got to do all these environmental analyses and all these different types of government NGO stuff that starts to pump money into that sector. And that was kind of like a supply constraint component. And then ultimately what happens under the Obama administration, they turn it into like an equity platform. So now it's like if you're going to build $100 million of something that's going to be economically impactful, not only do you have to go through the environmental analysis, you have to tell whether or not it is equitable in society. And it's like, guys, all we're trying to do right now is build a manufacturing plant and a refinery because we need oil. No, 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 no. We can't do that. That would be sacrilege. Treasury, they put Bob Rubin in charge, and if you know anything about Bob Rubin, he blew Citigroup up into a billion pieces. He was he was on the Council of Economic Advisors. He was very instrumental in Glass-Steagall. He was very instrumental in the Commodity Futures Modernization Act. He was very instrumental in basically setting the groundwork of allowing Citigroup to do whatever they wanted to do, and then he took Citigroup over. Andrew Cuomo joined the HUD. Well, Andrew Cuomo is considered the godfather of the housing crisis because he forced Fannie and Freddie to extend more lending to people who couldn't afford it. And that led to Fannie and Freddie blowing up, and then passive investing started in the 1990s. So, the PowerPoint from the wave speech. And that's somewhere. You just search for it. Just type it in. Type in the wave speech into the Google. Type my name, and there should be a PowerPoint in there somewhere. I don't have one on me right now. That I can't give you this one because the last time that I opened it up, somebody started like screwing with it. So I'll get it to you. We'll send it out. Guys, it's 9:22. I can't get a nap. I have to write another like 4,000 words, and then I have to go pick up my daughter. I will have to take a nap before I do that. And then I have to take my mother out for a belated Mother's Day. I'm going to wrap it up. It's been awesome. Guys, Sleepy Garrett at the helm. If you have any questions, I know that we invited a lot of people here who are not members. Join us. We do this every day at 8:30. Typically don't go this long, but we do that breakdown of the markets. Today, a couple of videos will be coming out a little later. The first one will be on China, kind of what the is going on with China and the United States. That's almost done. We'll also do a breakdown of some of the other things that I discussed earlier about the trilemma, dilemma, uh, lemma, whatever. We'll figure it out. And if you have any questions, you know where I am. I might be asleep, but hey, we got through it. I hope everybody has a good day. Thanks so much. Enjoy your Wednesday. I will be back in the morning at 8:30 on May 14th. Have a good day.